Go.
All right. I want to welcome all the guests to the first in a series of Lewis Thomason webinars on the COVID-19 financial packages being offered through the U.S. government, mostly the Treasury or the Federal Reserve. Before I get to some of my short slides, I want to make a quick introduction. Of course, I'm John Lewis, here with Lewis Thomason, and this webinar is being presented by our firm. This webinar is being recorded, so if you have to leave the webinar or you want to watch it again, you'll be able to access the webinar. And of course, you can email me. Tanya Freeman, who is our host, is also sent you some emails, has also sent you some emails in the past. Now, let me tell you a little bit about what we're doing. Again, before I get a little further, this webinar is designed at the most basic level to familiarize you with the programs that you've been dealing with, that you've received. 97% of you have received money under, but there's compliance issues, especially when it gets to forgiveness, that you've got to make sure, you must make sure that you are in compliance with. So the purpose of this seminar is to remind you about the programs and also to explain to you how the programs work. Now, we're going to have two panelists today, Davidson Lentz and Katie Goodner, both attorneys with my firm. Davidson is a IT and financial specialist attorney, and Katie is a tax and business financial person. Both of these attorneys have spent the last months now, I was going to say weeks, focusing on all the different programs and the programs to come, such as the Main Street Lending Program, which will probably be the subject of next week or the weeks after webinar. As each one of their slides is presented, you will see their emails and cell phone numbers for texting purposes. We won't have time to answer live questions, so they will respond immediately to your emails. And of course, if there's more work you need to have done, we are glad to help you or your professional team in any way we can on an engagement basis. So we're here to help you, and that's the point. Now, let's talk about today's presentation. What we know right now, is that, and this is legislatively, that there is two pieces of congressional legislation or Federal Reserve discussions going on right now. One is amendments to the PPP and the, quote, HEROES Act legislation, and the other is guidance on Main Street lending. So why don't we put that slide up, what we know right now, Tanya. All right, so what are we monitoring right now? Let's go to that slide. What we're monitoring right now today, as we're speaking, is legislation that is both in the House of Representatives and after they act will be in the Senate. And that is the amendment to the PPP program, the Payroll Protection Plan program. And of course, the most important piece of that, or two pieces of that, will be explained to you in detail by Davidson and Katie. They deal with what can we use the funds for, expansively, more than just payroll, and two, what are the terms and compliance requirements on forgiveness. So what do we still not know? Well, what we still don't know is what are the results of today's congressional hearings, the PPP and Main Street lending guidance that we're going to be getting from the Treasury and the government. So having discussed just in general those terms, let me now introduce to you Davidson Lentz, who will do an overview and summary of all the existing programs under COVID-19 and proposed. Uh, and then after Davidson will present Katie. So Tanya, ready to go with Davidson.
Thank you, John. I would like to start this webinar today with a brief walkthrough of some of the legislation and programs that have already been enacted, as well as some changes that have taken place within those programs as they've been implemented. As you can see from this slide, the phases of relief have come so far in 3 different phases, with a 4th potentially on the way. We are currently on phase 3 relief, which is the CARES Act. This is the large $2 trillion package that contains the PPP, as well as some other programs towards businesses. And as we start, we're going to go through these 3 phases of relief and take a pause on the Payment Protection Program. I'm going to pass it to Katie, who will go more in depth on the forgiveness application side of the PPP, before wrapping it up with a brief discussion over potential phase 4 relief that may be coming down the way. So to start, we're going to begin with the phase 1 relief, which is the economic injury disaster loans. And as you'll see on this next slide, this program has actually been in place for several years. It was originally intended to provide loans and relief to businesses suffering from natural disasters, such as tornadoes or earthquakes. But following the COVID-19 crisis, the government acted quickly to expand this program to provide financial relief to businesses suffering hardship due to COVID. And under the original terms, this program allowed up to $2 million on 30 years at 3.75% interest loans. These loans were automatically deferred for 1 year. Unlike the Payment Protection Program, this program does not offer any forgiveness. These are only loans. However, the low interest rate is meant to make up for that, and they can be used for a broader range of expenses than the PPP can. That said, this program is actually directly funded through the SBA. So it is the SBA that makes the determination of whether or not to give out any money, how much to give, and the terms of that loan. And with this discretion, the SBA has recently decided that the high demand of these EIDLs has caused it to limit the new loan amounts to only $150,000. So if you already have an EIDL pending, know that that $2 million mark is no longer what you'll be looking for. You're going to receive $150,000 or less, unless things change. And there is some pressure to change that and add more funding to it. But currently, as it stands, if you already have an application that hasn't been granted, that's the new limit. And along with that, the SBA has determined that it will only be accepting new EIDLs for U.S. agricultural businesses. So unless you have a U.S. agricultural business, if you have not already submitted an application, you can no longer apply for this program. That said, that does not mean you need to ignore this program. There is a lot of pressure on the SBA to open this program back up to a broader range of businesses. So it very well could come back and be a program to sign up for if you had not already in the near future. Following phase 1, we received phase 2 relief. This was the Families First Coronavirus Response Act. And this act is actually more intended to give benefits to employees rather than employers. And it contains 2 separate acts, the Emergency Paid Sick Leave Act and the Emergency Family and Medical Leave Expansion Act. The Emergency Paid Sick Leave Act provides 2 weeks up to 80 hours of paid sick leave at an employee's full rate of wages if the employee is unable to work because he is either quarantined due to the government or a doctor's recommendation, or if he is experiencing COVID-19 symptoms himself. Alternatively, the Emergency Paid Sick Leave Act provides 2 weeks up to 80 hours paid at 2/3 the regular rate of pay if an employee is unable to work because they have a need to take care of an individual who is subject to a quarantine, or a need to take care of a child whose school or child care facility has been closed due to COVID-19. And in addition to this program, we have the Emergency Family and Medical Leave Expansion Act, the expansion of FMLA coverage. This provides up to an additional 10 weeks of paid FMLA coverage paid at 2/3 of an employee's rate wages if the employee has been employed by that employer for at least 30 days and is unable to work due to the need to care for a child whose school or child care provider is closed or unavailable due to reasons related to COVID-19. And while these programs come with a cost to employers, the government has also built in a tax credit provision. Depending on whether or not you get certain funding under the CARES Act, you can apply and potentially receive tax credits up to 100% of the cost of these paid leaves. And following phase 2, we received the very large, big focus of most conversations, phase 3 CARES Act. That is the Coronavirus Aid, Relief, and Economic Security Act. This act contains multiple parts. It's a $2 trillion act. Most of the attention has been on the Payment Protection Program, as that applies to most people and has gotten the most coverage. But there are some other programs within the act that could benefit employers, as well as some specified provisions within the act that target certain industries. One of the main things it did, aside from the Payment Protection Program, is first it expanded the EIDL funding. Originally, the EIDL program did not have very much money, and this boosted billions of dollars into that program. And along with that, it created a cash advance grant for EIDL applicants where they could receive $10,000 immediately upon application for EIDL. Now, the SBA has since backtracked a little on that $10,000 advance and has decided that it should only pay $1,000 per employee up to $10,000, but that advance is still available if you had already applied under it or if you're now currently a U.S. agricultural business and apply for EIDL. Along with the EIDL expansion and the PPP, we also received eventually what became known as the Main Street Lending Program, as well as the Employee Retention Tax Credit. And I'm going to walk through the first three of these and pause on the Payment Protection Program about halfway through and pass it off to my colleague Katie, who will cover the forgiveness aspects of the PPP in much more detail, because that's really the focus right now of what people need to know. So first, with the Main Street Lending Program, this is an additional lending program. It is not a forgivable loan like the PPP, but instead is intended to support lending to small and medium-sized businesses that were in good condition prior to COVID-19. And this program will be funded up to $600 billion, which is about what the expanded Payment Protection Program had. So this is a large program. It's something to keep on your radar as a potential program that might benefit your business. And this program will actually operate through three separate loan facilities: the Main Street New Loan Facility, Priority Loan Facility, and Expanded Loan Facility. And the facility that applies to you is very fact dependent on your type of business and a determination that you'll need to make later. These loans will be issued through private banks with a treasury repurchasing up to 95%, depending on the type of facility, through a special purpose vehicle. And these loans can range anywhere from $500,000 to $200 million, depending on the facility that applies to your business. And most every business in the U.S. would be able to apply for this, because this business or this program applies to all businesses with up to 15,000 or less employees, or 2019 revenues of $5 billion or less. So most businesses in the U.S. right now should keep this on their radar as something to look at and look into. And the good news is you can receive both this loan program as well as the Payment Protection Loan Program. And that brings us to the Payment Protection Program. The Payment Protection Program, as everyone I'm sure is very familiar with, is the forgivable loan program. You can borrow at 2.5 times your 2019 payroll, up to $10 million. You have 8 weeks to get the money or to spend the money, and it's 100% guaranteed by the federal government. Any business with 500 or less employees is eligible to get this, unless you are in the food or hospitality, and then it's 500 employees per location, which makes it even broader. This program originally had $349 billion funded in it, which famously ran out of money very quickly. The government stepped in and funded it by an additional $320 billion, which as of Monday still has $150 billion in the program. So if you have not applied already for a PPP, or if you have only applied for a PPP for one of multiple businesses you may own, you have not missed the boat. There is still time to go and apply and get one of these forgivable loans. And that being said, the most important part about this loan is that it is forgivable. If you spend the money on payroll, mortgage interest, rent, or utilities, payroll up to 75%, then you can have up to the entire amount of the loan forgiven. And with that comes some additional guidance to look at. We've selected a few guidance here on this next slide that you'll see that address certain questions that we have been asked directly, and I feel are some of the important issues that are good to highlight, but this is far from all the guidance on the subject. We have SBA FAQ with over 40 questions answered, but these few I think are important to touch on. One is the limit of compensation of $100,000, and it turns out that that limit only applies to cash compensation, not non-cash benefits such as retirement, group health, or local taxes. So that should help in your calculations. Additionally, the program has reductions on forgiveness, which Katie will get into in more detail, involving maintaining the amount of employees on your payroll. And the guidance has come out because of concerns with the increase in unemployment benefits that some employees don't want to return, whether it's because they're getting paid more unemployment or it's because they don't feel safe to return. And the SBA has decided that if you make a good faith offer of an employee to rehire them and that employee turns it down, that will no longer count against you as far as forgiveness is concerned, which should alleviate a lot of concern for a lot of businesses. And additionally, last week, we got some clear guidance on an issue that we had been hearing a lot about from people and a lot of questions about, which was A, paying furloughed employees, or B, providing current employees either a bonus or some form of hazard pay for working. And the SBA has clarified that if you pay furloughed employees or if you pay a hazard pay bonus or other type of bonus, those payments are part of the payroll under the broad definition, and therefore they are forgivable. And so employers are free to make hazard pay to encourage employees to come in and work. And finally, one that has been addressed and asked by a lot of people, it seems somewhat obvious, but need to point it out, is whether or not you can make advance or prepayments on outside other expenses that occur outside of that 8-week covered period. And the clear answer to that is no. The SBA did not want you to use this money to go and pay November and December's rent and ask for that forgiven. However, as Katie's going to touch on at the end of this segment, there is some phase 4 legislation which may be expanding that 8-week window further, potentially even up to December. So the idea that you could do that might actually become a reality here in the next couple of days as that is voted on. And finally, before I turn it over to forgiveness, we're going to discuss briefly the SBA audits. This made the news. I'm sure everyone's aware. Some very large companies received millions of dollars under the Payment Protection Program. There was some outrage because people felt that those companies did not need the money. And the Treasury stepped in and said that they were going to automatically audit every loan above $2 million and spot audit lower loans to determine whether or not the certification that the money was necessary due to the uncertainty of current economic conditions was made truthfully. And this scared a lot of people, and they didn't know whether or not they should return the money. The SBA created a safe harbor period where people could return their money if they were worried that this vague definition might hurt them. We finally received some clarity on that as the SBA has decided that any loan under $2 million will automatically be considered to have made this in good faith, and only those loans over $2 million will be subject to this audit. And this audit will look at things such as the business's activity, reduction of business, and their ability to access other forms of liquidity, whether that's an open line of credit, cash reserves, or the ability to raise money on a capital market. That said, even if you're a small business, you shouldn't totally count yourself safe from any form of SBA audit. The SBA has made very clear that they will still review SBA or PPP loans, at their complete discretion, however they feel appropriate. And that could be your borrower's eligibility, the loan amount, how you use the proceeds, or how much was forgiven. It's all still on the table, and the SBA has indicated that you need to retain your records for up to 6 years following either forgiveness or repayment. So you're still on the hook of potentially getting an audit, and it's important to make sure that you cross your T's and dot your I's going forward, especially with forgiveness, because this may be looked at. It could even be 5 years from now. But as far as the good faith certificate or certification is concerned, you are considered automatically in the safe harbor. And that said, there will be an appeals process to any kind of SBA audit, and there will be a chance to have your voice heard and explain your side prior to any adverse finding. And with that, I'm going to turn it over to my colleague, Katie Goodner, who is going to discuss the forgiveness aspects of the PPP, as well as a little bit on some tax issues before wrapping it up with some of the future phase 4 legislation that is on the table. Katie?
Thanks, Davidson. As most of you know, the Paycheck Protection Program has been kind of the pinnacle of the CARES Act and has had probably the most conversation and discussion in the media and among tax and business professionals as we've tried to navigate figuring out exactly how this program is going to be implemented and what that means for our clients. We've spent the past couple of months, as John mentioned, since March 27th, working to understand this program, working with our clients to analyze what's best for them, especially as guidance has come out sometimes daily that often creates more questions than it does answers. The biggest kind of answer that we got most recently was the release of the Paycheck Protection Program loan forgiveness application that came out about 10 days ago. It answered some questions, it expanded some other issues, and it has created some options for borrowers. On the whole, most of us think that this has been good news. It's provided some more latitude in determining things like average FTEs. And it's answered some very specific questions that were coming up regularly about the paid and incurred expenses and how to calculate your time frame. There are three aspects that we're going to look at today. There are obviously a lot more to the application itself. I cannot stress enough how it is very borrower specific. So please let us know as you have questions. There is no one size fits all, or you're an A, B, or C. It's very business specific. And a lot of it involves both business judgment, legal analysis, some tax analysis, and a little bit of wait and see thrown into that as we wait for additional legislation. The three elements that we're going to look at today for the forgiveness portion are looking at your payroll calculation period, looking at how unused portions of a PPP loan would affect loan forgiveness, and also looking at your average FTE calculations, which was probably the biggest surprise for most of us that have been working with this a lot lately. If we look at the payroll calculation period, in the loan forgiveness application, this answered a big question that was coming up regularly with a lot of my clients. And for my clients who are on this webinar, you've heard me say this a lot. We know what we know right now, and we know what we think may change, but here's where we are. The loan forgiveness application answered this question, at least for right now. This is what is current. And it said, you can choose one of two ways to calculate your 8-week period. Because what was happening is people's loans were being funded, and the understanding was that the 8 weeks started on the date of the loan funding. But that might fall in the middle of your pay period. You may be right in the middle of a payroll period. So how does that paid and incurred come into play for your 8 weeks worth of payroll? What the loan forgiveness application does is it gives borrowers two options. One is just a basic covered period that begins on the date of the loan funding and runs for 8 weeks. And you'll see the example there on the slide using an April 20th loan funding date. But the second option, which is likely to be the best option for many borrowers whose loans funding date didn't happen to align with their pay period, is if you are a biweekly or more frequent payroll employer, you can choose the alternative payroll covered period method. And that allows you to start your 8 weeks on the first day of the first pay period after your loan funds. And there's an example there on the slide as well using the April 20th loan funding date, even if your pay period doesn't begin until April 26th. So that answered the question and provided some pretty good clarity on how do we calculate our 8 weeks. So then that leads us to the next question that got answered by the loan forgiveness application and the instructions that came with it. And this kind of applies across the board, but is more specific to borrowers who received a loan that they don't think they're going to be able to use the full amount. For a lot of borrowers, especially who received PPP loans in that first wave before the initial round of funding went out, or if you were early on in the second wave, you may have received a loan but you can't reopen. You weren't able to reopen for several weeks after, or you've been in a phased reopening that has not allowed you to get anywhere near back to your FTE count or to have payroll where it needs to be for that 75% threshold. We're going to set aside the prospect right now of that 8 weeks being extended, that June 30th date being extended, which is very possible. But for right now, what the ASBA and what we've received in this loan forgiveness application says is that you can calculate your forgiveness based on the lesser of one of three amounts. So if you got a larger amount but you couldn't use it all, you can still pay back part of that amount, and we're going to calculate based on the amount that was used. Or you can choose to use the portion that wasn't and consider it a loan. But I've got an example that we'll go through here in a second, very briefly, but it's going to be the lesser. Your forgiveness portion is going to be the lesser of either the total amount of the PPP loan, the amount of the loan used for eligible payroll costs divided by 0.75, or your modified amount of your PPP loan adjusted for any FTE reductions, if you aren't able to get back to that FTE number, or any salary or hourly wage reductions, if you were not able to pay employees at least 75% of their prior salary. And again, these are very borrower specific. There is no one unique formula. There's a worksheet that's in the loan forgiveness application that we're working through with a lot of clients. But there is no one answer for a borrower. It's going to be very borrower specific. So if we go to the next slide, you'll see that I've thrown up an example here for a company that receives $1 million loan, but only uses $750,000, and only $525,000 of that was actually used for covered payroll expenses. We're going to not get into FTE reductions or salary or hourly wage reduction issues because that is so specific. But you can see here how the lesser amount ends up being the $700,000 number because they weren't able to use the full balance, leaving a $50,000 loan. Or if the borrower chooses to not to return the remaining balance at the end of the 8 weeks, there would be a different analysis. But this is a very oversimplified example to show how that loan forgiveness amount can be calculated. And finally, which is probably the issue that's probably the biggest surprise in the loan forgiveness application, is the full-time employee average FTE calculation, and that's on this next slide. As many of you who filled out PPP loan applications may remember, the application asked you to take your average FTEs for the reference, what many of us call the reference period. Your reference period was either all of 2019 average, the similar time period for 2019 if you're a seasonal business, or if you're a new business, the early part of 2020. And put down your full-time employee count for that, your average FTE for that period, for the reference period. What the loan forgiveness application does is say, well, we're not going to worry about, we're going to keep those reference periods, but we're not going to use what you would probably normally consider a full-time employee definition. Many of us, and there was this question beforehand of, well, what is an FTE? And we used a 30-hour-a-week or more example that we see in other federal legislation like the Affordable Care Act, and felt that that was a safe recommendation. At this point, with the loan forgiveness application, says we're actually going to give you two formulas. And again, very borrower specific. And I would highly advise that you run both scenarios for your business, both for the reference period and for the covered period, to see which ends up working out best for you. Because option one takes the number, for each employee, takes the number of hours that they worked on average for each week working, divides it by 40, and you round it to the nearest 10th. And you'll see an example below that. What you end up with is the only employees who are going to count as a full-time employee are 38 hours or more as one full-time employee. Doesn't matter if they work 50 hours or if they work 38 hours, they're still one employee, one full-time employee. Then you continue working down. So you may have some employees who are a 1, some who are 0.5, a 0.2, a 0.7, and then you total it all up to get your average FTEs. You'll need to use the same formula for the reference period as you do for the covered period, which is why it's important to do it under both for each period, both of these scenarios for each period. Option 2, which they're calling the simplified method, basically gives you two options for employees. They are either a 1 or a 0.5. But in order to be a 1, they have to work 40 hours or more on average. Everybody else is a 0.5. So for employers who have a lot of employees below that 40-hour number, or if you've got a lot in the high 30s, that's where you're really going to have to work through this nuance. And that's where we've been working with our clients regularly to kind of figure out what this looks like, working with HR departments and CFOs and business owners to determine, okay, how is this going to play out specifically for your business? And we also need to make sure that this is run closer to the 8-week expiration deadline, because your numbers may continue to change and that may pivot you between option 1 or option 2. The other thing that needs to kind of be addressed for the CARES Act, getting us out of the PPP loan forgiveness, and that's kind of a lesser known program, is the Employee Retention Tax Credit. And part of the reason is that these are not forgivable loans. It's not quote unquote free money that's coming down from the government, but it is a tax credit that's available. It's available to limited employers. You have to qualify. And so what we've done is create a step-by-step analysis to see if this is actually a tax credit for which your business may qualify. So we'll talk about qualification and then how to claim the credit if you do qualify. So if we go to the next slide for step 1, there are 2 threshold questions that you have to answer to see if you even qualify for Employee Retention Tax Credit. And one was your business shut down fully or partially by government order? Or did your quarterly revenues drop below 50% for the comparative quarter in 2019? If the answer to those questions are no, and you can't answer either one in the affirmative, you don't qualify. If either is a yes, then you go to step 2. And are you a government entity? If you are, you don't qualify. Did you receive a PPP loan? If you are, you don't qualify. But I want to do a caveat here that many employers and small businesses and large businesses did receive PPP loans and returned them. If you returned a PPP loan, you are eligible for the ERTC. So just because you received and returned it, it does not make you ineligible here. So assuming that you passed our first 2 steps and you are eligible as an employer, we go to step 3, which is looking at the size of your company. And what the government has said and what the CARES Act provides is that we're going to put you into one of 2 categories, either more than 100 FTEs or less than 100 FTEs, 100 or more, excuse me, or less than 100. And what we've discovered as I've walked through this with clients, as we've discussed kind of how this application plays out, is that there is a much larger benefit for the employer if you are an employer of less than 100 employees. It's not to say that there's no benefit to you as an employer if you have 100 or more. It's just that the benefit shifts more from employer to employee at that point for the most part. Affiliated entities are going to be treated as a single employer if you meet the 50% similar ownership threshold. So that's something else to consider. If you have multiple affiliated entities, all under 100, but have similar ownership, those will be combined and may put you over that 100 employee threshold. Once you know which category you fall under, you'll see on this slide why the benefit is stronger for the employer if you have less than 100 employees. If you have more than 100 employees, you can only get a credit for the wages that are paid to employees who aren't working. And I'm going to repeat that. The credit only applies to wages paid to employees who are not working, either due to the shutdown or lack of work. So for a lot of employers, they're having to say this really isn't a benefit for the employer. This is just keeping employees paid. If you have valuable employees that are not replaceable, you've spent a lot of time and money training them and you want to keep them, this may be a benefit for you. However, if you are an employer with less than 100 employees, that not working requirement goes away. And the credit can be claimed for wages paid to employees, whether they're working or not. And that's really where we see the benefit more for the employer on the smaller side. Wages includes health insurance benefits, any health benefits, as long as those are paid in addition to other wages. But there are certain things that don't qualify as wages that we can look at on the next slide that would not be included in that tax credit. Those include sick or family leave credits, severance paid to any employee that has been let go during the quarter that's in question, any previously arranged PTO, or wages that the employer is already receiving other tax credits, such as FMLA, work opportunity tax credits, or the tax credits that Davidson mentioned under the FFCRA earlier. And finally, how to claim this tax credit is kind of the last step on this, because it is a payroll related tax credit. And you can do that by just simply retaining your payroll taxes and not remitting. You can claim in advance if the cash is needed in advance before you would otherwise be required to pay it. And there's a form that the IRS has provided for that, Form 7200. You should also be aware, if you're claiming this tax credit, the IRS has issued an updated Form 941 that will be used for second quarter forward of 2020 that reflects this tax credit. Or you can simply pay and request a refund with your quarterly 941 filings. It's important, similar to the PPP, and what I've been advising my clients with the PPP loan application, is to document your reason for filing the application for PPP. And same thing here. It's important to document your reasons for claiming this employee retention tax credit. Document any government orders that affected your business specifically, keep a file with that information. And if you happen to fall outside of the government shutdown order, but into the 50% reduction in gross revenue compared to 2019, go ahead and pull that information together. A lot of it you may not have because we're not at the end of the second quarter of 2019 yet. And those are a lot of conversations that I'm having with clients as we kind of truck toward that deadline. That wraps us up on the employee retention tax credit and kind of gets us out of what we know right now and into what we're monitoring. And what we're monitoring is just current legislation that really affects a lot of the questions that have come up, a lot of the problems that we've seen in the application of the PPP, the ERTC, and other components of these stimulus packages. There are 3 acts, and we'll walk through them pretty quickly: the HEROES Act, the Small Business Expansion or Expense Protection Act, and the Paycheck Protection Program Flexibility Act. The HEROES Act is the first one that was passed. A lot of people are probably most familiar with that one. It was passed in the House, but it has not yet gone before the Senate. And some big changes, there are a lot, but some of the ones that would really kind of come to play for businesses are a disallowance of the net operating loss carryback change that was made in the CARES Act. What this does was swing this pendulum back in the other direction, saying, nope, we're not going to allow those losses for years prior to 2018, which, if you're familiar with the CARES Act, and we may talk about this further on future legislation once we have more guidance, it really expanded the carryback period for net operating losses. The HEROES Act also, and this is probably one of the things that I feel most strongly will receive some type of change because there's bipartisan support and we see it both in the House and in the Senate, is the deduction of qualifying expenses that businesses pay using PPP loan funds that are ultimately forgiven. What happened was, in mid-April, we received IRS Notice 2020-32, which was a surprise to a lot of legislators and a lot of business owners, that says if you use PPP loan funds for what would otherwise be ordinary and necessary business expenses that would be deductible, you can't deduct those expenses. If you pay your rent, your mortgage, your wage expenses using PPP funds, you don't then get to deduct that. And the intent was to avoid double dipping, not claiming it as income, but being able to claim it as an expense. Both houses of Congress, both chambers of Congress, and a lot of legislators have said that was not the intent of the CARES Act. And so you see a change here, which would be overriding that notice. The HEROES Act also adds additional enhancements to the employee retention tax credit that I discussed a few minutes ago that would cause it to mirror the PPP more, allowing more tax credits for rent, utilities, etc. Then we get to the Small Business Expense Protection Act, which is pretty narrow, and it was introduced in the Senate in early May. And what you'll see is it does the exact same thing for IRS Notice 22 in the Senate that the HEROES Act does in the House. So you see that you've got support in both chambers of Congress as well as bipartisan support on that issue. So that is an issue we would anticipate changing, even though it hasn't changed yet. And then finally, we get to the Paycheck Protection Program Flexibility Act. And this really came about because of the outcry of the June 30th deadline, businesses saying we need longer than 8 weeks We are not going to be able to get back up and running by June 30th. And the fact that, as Davidson mentioned earlier, there's still $150 billion in loans available that haven't been issued, that we're well within the 8 weeks of June 30th now at the end of May. What the PPP Flexibility Act does, it was introduced in the House on the 15th, and we're expecting a vote today on the House, but as of the start of this webinar, nothing had been voted on yet. It extends the use of PPP loan funds beyond the current 8-week time period. The act as written proposes 24 weeks or December 31st of 2020. I know many in the restaurant industry and other service industries have been pushing for that 24-week time frame. I would anticipate that there's going to continue to be discussion there, but I think this is something that has bipartisan support. It also removes the 75% threshold for payroll expenses to be eligible for loan forgiveness, and completely eliminates any threshold, and says that the CARES Act never intended for there to be a threshold that has to be spent on payroll in order for the loan to be forgiven. That's a pretty consistently bipartisan, well-supported issue as well. Finally, well, not finally, second to last, there's an extension of the June 30th deadline for rehiring, and the current proposed date would be December 31st of this year. Again, there's broad support for that issue. And it would also allow for payroll tax deferment regardless of whether or not the borrower receives forgiveness of their PPP loan. At present, employers are, if you're familiar with the CARES Act, the employer portion of the Social Security tax, employers are eligible to defer that. Businesses may defer that portion of the tax, that's 6.2%, even if they received a PPP loan up until the date that they get a decision on their loan forgiveness. What the PPP Flexibility Act says is we're not going to limit that if you get your loan forgiven. We're going to just eliminate that restriction right there. And that's a great benefit. I've worked with a lot of clients, had a lot of conversations about the deferment of Social Security tax, because that's available to all employers right now, and is essentially a free loan for many folks. That gets us through current legislation and what we're monitoring. There are still things that we don't know, and a lot of it is when we're going to have answers from Congress on these issues. For some folks, the 8-week period, if you received your PPP loan early in this process, your loan 8-week period is set to run after the first week of June, sometime in that second week. So we're getting close. We don't know if we'll have answers on everything by then, but we do know that Congress is moving quickly. We also don't know what additional stimulus measures are coming down the pike. There's been a lot of talk, but we don't know what this next phase or next wave may be from a legislative standpoint, if there are going to be additional measures that are going to be available, such as the Main Street Lending Program, which we already know is coming, but if there are going to be others. We also don't know exactly how to handle the FFCRA and CARES Act interaction for employers who were planning on taking advantage of the tax credits under the FFCRA that Davidson mentioned earlier, but also received PPP loan funds and aren't sure whether or not it would be to their benefit to take the tax credit or use the loan. And I've worked with several clients on going through that analysis. We don't know that we'll be getting any further guidance, but we can certainly help you make that decision, and have been doing that regularly. That wraps us up for today's webinar. We really appreciate you joining us. As I mentioned earlier, this is a very borrower-specific analysis. There are a lot of questions. There's not a lot of one-size-fits-all answers. Our team has been working, I think, around the clock a lot of days for the past couple of months, working with our clients to make sure that we give you the best advice and we stay as up to date as possible on how best to help you make your business decisions. We invite you to join us next week, Wednesdays at noon Central, 1 o'clock Eastern, for our webinars. We anticipate the next webinar, a few webinars, being much shorter, as we will only have a week's worth of information to update. And we also invite you to subscribe to our email, which will be an email that comes out if there are things that are more time sensitive, to kind of keep you up to date if we have something that happens before our next webinar. Our contact information is up. We any inquiries. And again, we really appreciate you joining us today.
Yes, and this is John. Again, thank you very much. And again, the email address, those of you that prefer to text, you can text. But please make sure if you have any or if you need any further guidance to contact either Katie or Davidson. Again, thank you for joining. We'll see you next week.